A winning trader thinks in probabilities, not certainties. He does not search for the perfect setup, the flawless indicator, or the guarantee that the next trade will unfold exactly as he imagines. Instead, he builds a mindset that accepts the inherent uncertainty of every single moment in the market. To him, uncertainty is not a threat. It is the natural environment in which opportunity exists. The losing trader resists uncertainty, trying to force the market into a predictable pattern. The winning trader embraces it, knowing that his edge is not in predicting the future, but in responding to whatever the market reveals. The winning trader understands that every trade is a unique event. No two patterns, structures, or conditions are ever identical, even if they appear similar on the chart. This realization frees him from emotional attachment to outcomes. He does not burden any single trade with the weight of his expectations because he knows the market owes him nothing. His only concern is executing his edge consistently, with clarity and without hesitation. He operates from a psychological framework built on trust. Trust in his process, trust in his risk parameters, and trust in his ability to remain aligned with the flow of the market rather than fighting against it. Where losing traders obsess over being right, a winning trader is obsessed with being objective. His sense of self-worth is not tied to the outcome of a trade. He has separated the result from the identity. This allows him to see the market as it is, not as he wants it to be. When he is wrong, he accepts it instantly without resistance. When he is right, he does not become overconfident or reckless. Every outcome is simply another piece of information, another data point that contributes to his continuous adaptation. A winning trader thinks in terms of process rather than outcome. To him, the real victory is not the profit, but the discipline to execute flawlessly. The market is a mirror, revealing his strengths, weaknesses, impulses, and fears. He does not avoid this mirror. He uses it as a tool for growth. He understands that trading success does not come from mastering the market, but from mastering himself. He is aware of the subtle pulls of fear, greed, and impatience, and he trains his mind to stay centered despite them. Consistency becomes his greatest weapon, because he knows that the market rewards those who can remain emotionally balanced regardless of the circumstances. Above all, a winning trader thinks in alignment with the market's truth. Anything can happen. Once this truth is fully accepted, psychological freedom replaces emotional struggle. Decisions become cleaner, actions become smoother, and the hesitation that once sabotaged performance dissolves. In this mental space, the winning trader operates with confidence, not the confidence of certainty, but the confidence of competence. This is the mindset that allows him to navigate chaos with calm, probability with clarity, and opportunity with precision. Thinking in probabilities is the psychological foundation of every winning trader's mindset, because it shifts the entire way you interpret market movement, manage risk, and respond to uncertainty. When you think in probabilities, you free yourself from the rigid belief that any single trade must work, that any setup must unfold exactly as expected, or that market behavior should conform to your analysis. Instead, you adopt a flexible, fluid, and statistically grounded way of viewing every outcome. This shift may sound simple, but internally it represents a complete transformation in how you relate to the market. It requires you to dissolve the need for certainty, abandon the desire to be right, and accept the reality that every moment on the chart is unique. No matter how perfect a setup appears, it does not guarantee a specific result. By internalizing this truth, you begin to trade from a place of clarity rather than fear, from objectivity rather than emotional distortion. Most traders unconsciously approach the market with a deterministic mindset. They analyze the chart, identify a pattern, and expect the market to behave according to that pattern. When it doesn't, they respond with frustration, disbelief, or self-doubt. This reaction doesn't come from the market. It comes from the internal expectation that the market should behave a certain way. Thinking in probabilities eliminates this emotional conflict. If a trade goes against you, it simply reflects the natural distribution of outcomes within your edge. Nothing more, nothing personal, nothing to be emotionally drained over. Each loss is one small part of a much larger statistical picture, a single point within a series of outcomes that, over time, work in your favor if your edge is truly valid. To think in probabilities means you deeply understand that the outcome of your next trade is unknown, but the outcome of the next 100 trades is relatively predictable if you execute consistently. You stop trying to control the present moment and instead control your behavior across many moments. The winning trader doesn't. judge his competency based on the result of one trade. He evaluates himself based on the quality of his execution and the consistency of his process. When you think this way, losses no longer represent failure. They represent normal, expected costs of participating in an uncertain environment. This mindset frees you from the emotional roller coaster that destroys so many traders. You no longer swing between euphoria and fear, confidence and doubt, aggression and paralysis. Instead, you operate in a stable, grounded state because you know that the market isn't against you. It's just expressing probability. Another vital aspect of thinking in probabilities is the ability to let go of the illusion of control. Traders often believe that if they study enough, analyze enough, or observe enough patterns, they can predict the future. But true market control is impossible. What you can control is your risk, your entries, your exits, and your mindset. When you embrace probabilities, you shift your attention from the uncontrollable to the controllable. This transition removes the psychological pressure that comes from trying to force the market to reward you. Instead of saying this trade must win, you say this trade has a high probability of working, and if it doesn't, I'm prepared. That preparation, emotionally and financially, is what allows you to trade with genuine confidence. Probabilistic thinking also requires you to view market information neutrally. When a trade is running in profit, you don't assume it will continue. When the market begins to pull back, you don't assume it must reverse against you. You interpret every shift as part of the natural behavior of price. You begin to understand that the market is always offering information, but it is never offering certainty. The winning trader does not overreact to each tick or candle because he doesn't interpret the movement as a personal confirmation or rejection. He simply sees it as another expression of probability, another unfolding of the collective decisions of market participants. When you truly think in probabilities, your relationship with risk transforms. Risk is no longer something to fear or avoid. It becomes a necessary component of the game. If taking risk is what allows you to realize the potential of your edge, then risk becomes a tool rather than a threat. This shift reduces hesitation because hesitation is almost always rooted in fear. Fear of loss, fear of being wrong, fear of experiencing negative emotion. But when losses are normalized and expected, fear no longer has the same power. You become more decisive, more fluid, and more consistent because you no longer freeze between what you want and what you fear. Thinking in probabilities also sharpens your discipline. Instead of bending your rules to chase certainty or avoid loss, you follow your rules precisely because you understand that consistency is the only way to let probability work in your favor. Without consistency, your edge cannot express itself. Each deviation you make dilutes the statistical structure of your outcomes. A winning trader isn't disciplined because he forces himself to be. He is disciplined because he knows that inconsistency destroys probability. This understanding becomes internalized to the point where discipline feels natural, not restrictive. Perhaps the most profound transformation that comes from probabilistic thinking is emotional neutrality. You stop attaching hope, fear, or personal meaning to each trade. You stop interpreting wins as validation or losses as punishment. The market becomes a neutral environment, and you become a neutral observer and participant. This neutrality is what allows you to perceive the market clearly. You stop projecting your expectations onto the chart and instead allow the chart to reveal itself without distortion. You no longer see what you want to see, you see what is. This clarity sharpens your decision-making, because without emotional interference, your logical mind remains in control. Finally, thinking in probabilities creates a sense of psychological freedom. You are no longer enslaved by the need to be right, the fear of being wrong, or the pressure to avoid losses. You understand that your power lies not in controlling the outcome of a single trade, but in controlling the consistency of your actions across many trades. This freedom allows you to trade with calm, precision, and confidence in an environment where uncertainty is constant and unavoidable. Detaching emotionally from each trade's outcome is one of the most critical psychological shifts a trader must make in order to become consistently successful. Most traders enter the market with a subconscious emotional investment in every position they take. They hope it will work, they fear it might fail, and they attach a personal sense of achievement or disappointment to whatever result unfolds. This emotional attachment creates inner tension, distorts perception, and interferes with the trader's ability to remain objective. When you detach emotionally, you begin to see the market with clarity rather than through the lens of personal expectations. You shift from reacting impulsively to responding intelligently. You no longer view each trade as a reflection of your skill, your intelligence, or your worth. Instead, you see it as a single probabilistic event within a much larger series of outcomes that do not define you. Emotional attachment to outcomes often forms because traders unconsciously link their identity to being right. A winning trade feels like proof that they understand the market, while a losing trade feels like proof that they are failing. This emotional entanglement creates pressure that clouds decision-making. When you detach emotionally, you learn to separate yourself from the results entirely. A loss no longer threatens your confidence. A win no longer inflates your ego. Both outcomes become neutral forms of information rather than emotional triggers. This neutrality allows your mind to stay balanced, which is essential for consistent performance. When the emotional weight of a trade is removed, the market stops feeling like an adversary or a test. It becomes a flow of opportunities that you participate in without fear or expectation. Detaching emotionally also means releasing the need to control what happens after you place a trade. Many traders enter a position and then immediately become psychologically consumed by it. They watch every tick, every small fluctuation, interpreting each movement as a personal hint about whether they will be rewarded or punished. This creates emotional turbulence that makes rational decisions nearly impossible. When you detach, you accept that once your trade is placed, the outcome is out of your hands. You've already defined your risk, chosen your entry, set your parameters, and aligned yourself with your edge. Everything beyond that point is simply the natural dynamic of the market. Your job is no longer to interfere or try to force the outcome. It is to let the probability unfold without emotional interference. The more emotionally attached you are, the more reactive you become. Emotional attachment causes premature exits, impulsive entries, moving stop losses, revenge trading, and the inability to let winners run. These behaviors are not symptoms of poor strategy. They are symptoms of emotional dependence. When you detach, these destructive impulses weaken. You no longer feel compelled to save a trade that is moving against you out of fear. You no longer feel the urge to jump in early because you are afraid of missing out. Your decisions begin to follow logic and structure rather than emotion. This creates the psychological stability required to execute your plan consistently. Detachment also allows you to treat each trade as independent from the last. Traders who remain emotionally attached often allow previous outcomes to influence present decisions. A big win leads to overconfidence and excessive risk-taking. A painful loss leads to hesitation and avoidance. Both responses create inconsistency. When you detach, you reset after every trade. You do not allow the emotional residue of past outcomes to leak into your decision-making. Each trade becomes a fresh event with no emotional baggage. This mental reset is what allows professional traders to maintain consistency even after streaks of wins or losses. A significant part of emotional detachment comes from accepting the unpredictability of the market. When a trader resists uncertainty, emotional tension grows. They believe the market should behave according to their expectation, and when it doesn't, frustration or fear takes over. Detachment is rooted in the understanding that anything can happen. When you fully accept this, the psychological pressure dissolves. You no longer feel betrayed when the market moves unexpectedly because you no longer expect certainty. This acceptance makes it easier to let go of results because you understand that outcomes are not personal. They are simply manifestations of probability. Emotionally detaching also requires you to trust your edge. If you do not genuinely trust your strategy, your risk management, and your ability to execute, you will cling to each trade emotionally, hoping it rescues you or fearing it may expose you. Trust removes this desperation. When you believe in your process, you no longer need each individual trade to validate you. You trust that over time, your edge will generate the results you seek. This trust is what allows you to detach. Without trust, detachment is impossible. Another dimension of emotional detachment is learning to interpret losses without emotional narrative. Many traders assign meaning to losses. They see them as failures, setbacks, or reflections of personal incompetence. This emotional narrative amplifies the pain of losing and strengthens attachment. When you detach, you see losses as neutral costs of doing business. They are not punishments, they are not failures, they are simply part of the statistical landscape of trading. This mental perspective reduces emotional volatility and prevents negative spirals that lead to impulsive decisions. Detaching emotionally also improves your ability to hold winners. Emotional attachment often causes traders to close winning positions too early out of fear that the profit will disappear. Detachment allows you to hold trades according to your plan rather than your fears. You no longer obsess over protecting every small gain. You allow trades to develop naturally, understanding that the outcome, win or loss, is simply another point within a long-term series. As you deepen your emotional detachment, your mind becomes quieter during trades. The internal dialogue of fear, hope, doubt, and excitement begins to fade. You no longer oscillate between emotional extremes. This calm mental state allows you to perceive market information more accurately because emotional noise no longer distorts your interpretation. Your decisions become cleaner, your execution becomes faster, and your psychological resilience strengthens. When you detach emotionally from outcomes, you elevate yourself from the level of the average trader, who is constantly pushed and pulled by internal emotional storms. You step into a mindset where trading becomes a process, not a battle, a flow, not a struggle, a statistical practice, not a personal test. This detachment is what allows consistent traders to operate with clarity, precision, and balance in an environment defined by uncertainty and constant movement. Focusing on process over prediction is the cornerstone of professional trading psychology because it shifts your attention away from trying to guess what the market will do and toward controlling what you yourself do. Most traders allow their minds to become absorbed by predictions, projections, and imagined outcomes. They try to forecast the exact path the market will take, believing that accuracy in prediction equates to success. But prediction is a trap. It creates emotional attachment, fills the mind with expectations, and places the trader in a mental position where they feel validated when the market confirms their prediction and attacked when it doesn't. By focusing on process instead, you anchor yourself to a repeatable structure that does not rely on being right about the future. This shift creates psychological freedom, consistency, and clarity because your performance stops depending on something you cannot control and becomes rooted in something you can. When you prioritize process, you begin to view the market through a neutral lens. You are no longer desperate to know what will happen next. Instead, you are interested in identifying what conditions align with your edge and executing when they do. This changes the entire emotional experience of trading. Prediction naturally feeds anxiety because the mind seeks validation. If the market hesitates, pulls back, or moves slowly, a prediction-based trader begins to doubt their analysis. That doubt leads to impatience or excessive monitoring of price. A process-focused trader, however, does not need the market to confirm his bias. His job is simply to follow his rules, take his setups, manage his risk, and allow the probabilities to manifest over time. Process over prediction also means acknowledging that any single trade is just one event within a large sample size. Predictions make the outcome of each trade feel overly significant. You either feel rewarded for being right or punished for being wrong. This emotional seesaw prevents long-term consistency. Process eliminates this dynamic by reframing every trade as one small execution of a broader system. You do not need to be right on any single trade because your edge expresses itself through a series of trades, not one. When your focus is on process, you stop reacting emotionally to wins and losses. They are simply data points within your long-term performance. A process-centered mindset also strengthens discipline. When you are driven by prediction, you tend to modify rules on the fly. You enter early because you think the move has started. You skip setups because you think the market looks weak. You hold losing trades because you predict the reversal. This inconsistency damages your probability distribution and undermines your edge. When your mind is anchored to process, you follow your rules not because you are trying to be perfect, but because you understand that inconsistency breaks the logic of probability. Discipline becomes less about forcing yourself and more about aligning your actions with the structure that creates long-term success. Another important element of focusing on process is the reduction of cognitive load. Prediction fills the mind with noise, endless mental scenarios, what-if questions, biases, opinions, and emotional interpretations. This mental noise interferes with your ability to read the market objectively. A process-based trader quiets this noise because the decision-making framework is predefined. You already know what conditions constitute a setup. You already know how much risk to take. You already know where to exit. This clarity reduces mental fatigue and allows you to trade with a calmer, more stable mindset. A quiet mind sees opportunities more clearly, evaluates risk more accurately, and avoids impulsive decisions. Focusing on process also enhances adaptability. Predictive thinking locks you into a single expectation. If the market deviates from your prediction, you resist accepting the new information. You hold on to losing trades hoping your prediction comes true. You ignore signals that invalidate your bias. This resistance creates emotional friction. A process-focused trader, by contrast, is fluid. The process tells him what to do based on what the market is showing now, not what he wanted earlier. Adaptability becomes natural because process is built on responding to the present moment instead of forecasting the future. This allows you to shift direction quickly when conditions change without emotional hesitation. A process-driven mindset also reinforces the understanding that trading is a probability game rather than a certainty game. Prediction encourages the illusion that certainty is possible if you analyze enough or wait long enough. Process removes that illusion. You recognize that your edge gives you a statistical advantage, not a guaranteed outcome. This frees you from the emotional pressure to be right and anchors you in the pursuit of consistent execution. You stop trying to force the market to comply with your expectation and instead learn to align with the market's truth. This alignment is what allows traders to operate with confidence even during periods of drawdown or volatility. When you focus on process, you create emotional stability. Prediction-based thinking often triggers fear when the market threatens your analysis and greed when price moves in your favor. Both emotions distort perception and sabotage execution. A process-based trader's emotional energy is not tied to market fluctuations, but to the consistency of his own behavior. This emotional independence gives you an inner stability that allows you to trade calmly even during uncertainty. The market can move against you, move unexpectedly, or move slowly, and you remain unbiased because you are not emotionally invested in any single outcome. Prioritizing process also improves your long-term growth. When your focus is prediction, you evaluate your performance based on whether you were right or wrong. This makes learning difficult because you equate correctness with skill rather than evaluating the quality of your decisions. A process-oriented trader evaluates performance based on adherence to rules, clarity of execution, and quality of decisions. This creates a structured feedback loop that allows you to improve continuously. You begin to identify where emotional impulses interfere, where discipline falters, and where your edge needs refinement. Growth becomes systematic rather than chaotic. A process-focused mindset also helps you remain patient in the market. Prediction often creates urgency. You feel compelled to act because you think you know what will happen next. This urgency leads to overtrading, chasing moves, and taking low-quality setups. Process removes urgency because your actions are dictated by predefined conditions. If the conditions are not present, you do nothing. This patience protects your capital, conserves your energy, and ensures that you only engage when probability is in your favor. Finally, focusing on process over prediction allows you to develop the confidence that comes from competence rather than luck. Prediction-based traders often misattribute success to their ability to foresee the market. When the market shifts and predictions stop working, their confidence collapses. A process-based trader's confidence is deeply rooted in his ability to execute his system with consistency. This type of confidence is stable, resilient, and independent of recent outcomes. It is built on mastery rather than hope, on structure rather than emotion, and on clarity rather than expectation. Accepting that anything can happen in the market is one of the most liberating and transformative realizations a trader can internalize, because it breaks the illusion of certainty that traps most traders in cycles of frustration, fear, and disappointment. The mind naturally craves predictability. It wants patterns that repeat reliably, conditions that behave consistently, and outcomes that confirm expectations. But the market is a living environment shaped by countless participants, each acting on different motivations, information, emotions, and time horizons. This complexity makes the market inherently uncertain, and the moment you truly accept that anything can happen, your entire psychological relationship with trading changes. You stop looking for guarantees and start aligning with probabilities. You stop imposing personal expectations onto the chart and start allowing the market to reveal itself without resistance. The resistance to uncertainty is one of the biggest obstacles for traders. When you subconsciously believe that the market should behave according to your analysis, you experience emotional turmoil whenever it doesn't. A setup looks perfect. You take the trade and the market moves in the opposite direction. Instead of accepting it as a natural expression of randomness, you internalize it as something that shouldn't have happened. This emotional resistance creates tension and triggers reactive behavior. Accepting that anything can happen dissolves this tension. It allows you to experience unexpected outcomes without emotional disruption because you no longer view them as violations of how the market should behave. They simply become natural possibilities within a dynamic environment. This acceptance also breaks the attachment to being right. Most traders enter trades hoping to prove their analysis correct. Their sense of confidence rises and falls based on the market's alignment with their expectations. But the desire to be right creates psychological pressure that distorts perception. When you accept that anything can happen, you no longer use the market to validate your intelligence or skill. You take trades not because you expect to be right, but because the setup aligns with your edge. The outcome becomes secondary. This shift frees your mind from the emotional burden of needing the market to move in a specific direction and allows you to trade with a calmer, more objective mindset. Accepting uncertainty also strengthens your risk management instincts. When you believe you know what will happen next, you are more likely to take excessive risk or ignore protective measures. Overconfidence leads to oversized positions and loose stops because the mind feels justified in assuming a favorable outcome. But when you fully accept that the market can move in any direction at any moment, risk becomes something you respect rather than dismiss. You begin to place stops not because you fear the market, but because you acknowledge its unpredictability. Position sizing becomes discipline because you no longer assume that a setup will definitely work. This respect for uncertainty naturally aligns you with professional risk management behavior. Another powerful effect of accepting that anything can happen is the reduction of fear. Fear is almost always a reaction to the unknown. And when you resist uncertainty, the unknown becomes threatening. You fear losses, reversals, fake-outs, drawdowns, and every deviation from your expectation. But when you embrace unpredictability as a fundamental truth rather than a threat, the unknown stops feeling dangerous. You stop fearing unexpected movement because you no longer expect the market to behave predictably. This acceptance neutralizes fear and prevents it from interfering with execution. A trader who does not fear uncertainty can act decisively, hold trades patiently, and exit trades rationally. Accepting that anything can happen also enhances flexibility. Prediction-based thinking locks you into a single narrative. The market must go up, or it must go down, or it must break a level, or it must react to news in a certain way. When reality contradicts your narrative, you resist adapting because you are emotionally tied to your expectation. Acceptance removes this rigidity. You become willing to shift your bias, reverse a position, or sit on the sidelines without feeling conflicted. Your mind becomes fluid, and you begin to move with the market rather than against it. This adaptability is one of the traits that separates consistent traders from struggling ones. This mindset also sharpens your ability to read the market objectively. When you expect the market to behave in a certain way, your mind selectively filters information to confirm or support that expectation. This confirmation bias blinds you to clear signals that contradict your prediction. When you accept uncertainty, you stop projecting your expectations onto the chart. You observe what is actually happening rather than what you want to happen. This clarity improves your ability to identify real opportunities and avoid traps. Accepting that anything can happen further strengthens emotional resilience. When outcomes no longer carry personal meaning, you stop reacting emotionally to wins and losses. A losing trade is not a shock or a disappointment. It is simply a possible result that you already accounted for. A winning trade is not a validation. It is another expected outcome within the probability distribution. This emotional neutrality allows you to remain steady during streaks of losses and grounded during streaks of wins. You become less affected by randomness and more focused on consistent execution. Another aspect of accepting uncertainty is the ability to release control. Most traders experience psychological tension because they try to control the market through analysis, expectations, or predictions. But controlling the market is impossible. When you let go of control, you stop fighting the natural flow of price. Your decisions become more intuitive and less forced. You execute your plan without hesitation because you no longer feel responsible for manipulating the outcome. This release of control creates mental ease, which improves performance. Accepting that anything can happen also reinforces the importance of statistical thinking. Once you acknowledge unpredictability, you naturally understand that individual trades are irrelevant in isolation. What matters is how your edge performs across many trades. This understanding helps you remain consistent even when individual outcomes appear random or contradictory. Your confidence begins to come from your process rather than your predictions. Your sense of stability becomes rooted in your ability to execute rather than your ability to foresee the future. Finally, this acceptance opens the door to psychological freedom. You stop fighting the market, stop arguing with its movements, stop resisting the unexpected. You operate within the flow of uncertainty rather than trying to eliminate it. This mindset frees you from emotional turmoil and allows you to engage with the market with greater clarity, patience, confidence, and composure. Maintaining consistent execution without hesitation is the defining characteristic of a trader who has internalized discipline, emotional balance, and trust in their edge. Most traders understand their strategy, know their rules, and can explain their risk parameters, yet they still struggle to execute with consistency. The gap is not in knowledge, but in hesitation. Hesitation arises from fear, uncertainty, doubt, or the emotional attempt to avoid perceived pain. It disrupts timing, erodes confidence, and creates a disconnect between what a trader knows they should do and what they actually do. When execution becomes consistent, this internal conflict disappears. You act without internal resistance because your decisions are rooted in a structured process rather than fluctuating emotions. Consistent execution is the practical expression of psychological mastery. You can have the best strategy in the world, but without consistent execution, the statistics behind that strategy cannot express themselves. Many traders fall into the trap of believing that small deviations from their rules are harmless. They enter slightly early, widen their stop a bit, skip setups because they dawn and feel right, or take trades that aren't quite aligned with their system. Each deviation seems small, but collectively they destroy the integrity of the edge. Consistent execution means you no longer negotiate with yourself in the heat of the moment. You follow the rules exactly as written because you understand that every deviation introduces uncertainty into the outcome. This understanding transforms discipline from something you force yourself to do into something that feels natural and logical. Hesitation is one of the greatest enemies of consistent execution. It often appears at the moment when your entry signal triggers. The market aligns with your criteria, but your mind begins to analyze, question, doubt, and imagine adverse scenarios. You start thinking about your last loss, the potential risk, or the fear that the trade might reverse immediately. This internal dialogue delays your action, and by the time you finally enter, the optimal moment has passed. The result is often a poorer entry, increased risk, or missed opportunities. When you maintain consistent execution, hesitation no longer interferes. You act the moment your rules tell you to act because you trust your system more than your emotional reactions. The decision becomes automatic, not impulsive, but grounded in structure. Trust plays a crucial role in eliminating hesitation. Traders hesitate when they don't fully trust their strategy, their analysis, or themselves. Building trust requires repetition, practice, backtesting, and experiential understanding. When you see over time that your edge works across a large sample of trades, trust becomes internalized. You stop expecting each trade to be a winner and instead trust that over many trades your method is profitable. This removes the pressure from individual decisions. You no longer hesitate because you no longer need any single trade to succeed. You simply play your role by executing your process. The results take care of themselves over the long run. Emotional neutrality also reinforces consistent execution. Emotions like fear, greed, and impatience create conflicting impulses that blur your decision-making. Fear prevents you from taking trades your system signals. Greed pushes you to risk more than you should. Impatience tempts you into trades outside your criteria. When you remain emotionally neutral, these impulses lose their influence. You become able to act based on logic rather than emotion. Consistent execution requires that you reduce emotional noise so your decisions reflect your strategy rather than your feelings. This neutrality creates a mental environment where you follow your rules naturally. Clear structure simplifies execution. Traders who rely on vague rules or discretionary guidelines struggle to execute consistently because there is too much room for interpretation. Consistency requires clarity. You must know exactly what qualifies as an entry, exactly where your stop goes, exactly how you manage risk, and exactly when you exit. The more detailed your rules are, the easier it becomes to execute without hesitation. Structure eliminates the gray areas where doubt creeps in. When your process is clear, decisions require no emotional evaluation. You simply follow what is already defined. Consistent execution also requires acceptance of uncertainty. A major reason traders hesitate is because they want more confirmation or more certainty before acting. They wait for the perfect candle, the perfect pullback, or the perfect signal. But perfection doesn't exist in the market. The desire for certainty leads to overthinking and missed opportunities. When you accept that no trade is guaranteed, you free yourself from the need for extra confirmation. Your execution becomes consistent because you understand that your job is not to predict, but to act when your setup appears. The acceptance that anything can happen reduces hesitation and reinforces trust in your predefined criteria. Another aspect of consistent execution is maintaining the same behavior regardless of emotional state. Many traders execute well when they feel confident but hesitate when they feel uncertain. They take trades aggressively after a win but cautiously after a loss. This emotional dependency creates inconsistency. Consistent execution means you act the same way whether you are winning or losing, whether you feel confident or doubtful. Your decisions remain grounded in your system, not influenced by your emotional swings. You separate your internal state from your external actions, allowing discipline to guide you even when emotions fluctuate. Consistency is also reinforced through repetition. The more frequently you execute your rules correctly, the more automatic those actions become. Repetition rewires your mind, reducing the mental effort required to follow your process. Eventually, you no longer think about whether to act, you simply act. This does not mean trading becomes robotic. It means you operate with clarity and without inner conflict. Repetition creates neural pathways that support fast, decisive, structured action. Maintaining consistent execution also improves recovery from losses. When traders hesitate after a losing streak, they break the continuity of their edge. This hesitation creates gaps in performance that distort long-term results. When you execute consistently even after losses, you allow the statistical nature of your edge to play out. You don't panic, reduce size irrationally, or skip valid setups. You understand that trades must be taken to allow probabilities to manifest. Consistency becomes your anchor during uncertainty. Lastly, consistent execution builds a stable self-image as a trader. You begin to see yourself as someone who follows rules, respects risk, and acts with precision. This identity reinforces discipline and reduces the likelihood of emotional deviation. When you see yourself as a consistent executor, your behavior aligns with that self-image. You become the trader you are trying to become through your actions, and those actions compound into long-term mastery,